Move on for you now. We are expecting some weighty losses at the open this morning. That is on the back of what happened on Wall Street Friday. George Lucas from InStreet with me now. George, interesting that you're saying, if anything, all the volatility hasn't really affected the fundamentals. You're still buying the US growth story.
At the moment, we're still buying the US growth story. I mean, there are going to be a lot of figures coming out this week, both in Europe and in the US, and hopefully we'll see that those figures confirm that the US growth story hasn't been affected, but at the moment the story's still on track.
Tell me about savings as well. Put it into context. You said there's been a bounce back, but coming off a very low base, right?
No, but I think, and we talked about this maybe 4 weeks ago, where there was a bit of a dip in the US savings. I think it fell below 3% for the savings, personal savings. But we've seen it rally back up to its high of 3.6%. And we believe that this can actually be sustained from increases in wages. And I think when the payroll figures come out at the end of the week, we'll start to see increases in salaries in the US. And on top of that, we're beginning to see quite strong profit growth in the US, but there's really no spending on capital, and so we're going to start seeing corporate saving rates go up as well. So all in all, there is an underlying growth in savings in the US, mainly being driven now not from a decrease in spending, but more from an increase in income.
The struggle, though, I guess, is for, US manufacturing now, because the weaker the euro gets, the more compelling their products become in the US market. And how do employers work against that? How can they keep paying their own workers more, as you say, in that sort of an environment?
Yeah, and this is actually the big switch. I mean, up to about a month ago, it was China who was the evil, cheap exporter, and what we're going to see it switch, and it's going to become Germany, which is a cheap, evil exporter to the world.
Hang on, they won Eurovision. We can't bag them.
No, we can't bag. I'm actually going for Romania, but, you know, there we go.
For what reason?
Oh, just at the
Family
time.
ties?
No.
All right. Good on.
And then but they were competitive. The exporters in Germany were competitive when the euro was at at 1.50 to the dollar. Now at 1.25, they're still competitive, and they're even more so competitive. And that's what the story is going to change, and we're going to see it switch from China being the evil exporter to Germany being the evil exporter.
Within what time frame?
Oh, you know, all these things take time, but, you know, by the end of the year we should start to see that. And it also takes a lot of pressure off China, where the US are coming out and putting a lot of pressure on China to appreciate their currency against the US dollar.
Realistically, George, was that just a lot of air miles clocked up by Tim Geithner but little else? So he gets to sit, you know, the pointy head without even thinking. But what did he achieve? Realistically,
it was a lot of it was politically driven, and a lot of it actually might have slowed down China appreciating their currency because America was coming out and talking about it, while China may have appreciated their currency early if everyone just ignored it. But you know, realistically, it's probably going to have very little effect, and now the problems have switched. That China has probably appreciated their currency 5% against the euro, and China is Europe's main exporter, and China is becoming a major export market for Europe.
We'll talk about currencies appreciating. You talk about the 70% now aggregate US profits that have been clocked in, right, of late. You've pointed to this. Now, you've said 70% of US companies have beaten their earnings expectations, put it that way. How long can we rely on that trend continuing, given the strength of the US dollar, given that key components of the US markets derive their earnings offshore, a large share of them?
A large share of them. And they've been a lot of the large companies, and so we're going to see a little bit of switch back, and we've seen this in the States, switch back to companies that derive their income mainly in the US, and already companies like McDonald's have come out and warned that the stronger euro will have an effect on their earnings this year. And, you know, it has been one of the major drivers of US earnings, the depreciation of the US currency.
So if it falls back on the US consumer, but we were talking about an increased savings mentality, which one wins out?
Yeah, but I think the increased savings mentality is not coming from a cutback in spending now. It will come from an increase in the income that they're earning, and that's the difference. That's the change. So
does that bring forward inflationary pressures? Does that force the Fed to raise sooner than later? Because you can't have your cake and eat it too. You get inflation.
No. inflation is driven by a lot of other things, just besides just what consumers are doing.
But wages are a key component.
Wages are a key component, but they have to go a long way before they start creating inflationary pressures in the US, especially when unemployment is sitting at nearly 10%. And the capacity utilization is in the low 70s. There's a long way to go before you start worrying about inflationary expectations.
All right, tell me then about the way you're reading Europe. Now, people said Spain, no surprise. Mark Bailey saying to this from Equasia earlier, it's more who could be next. It's the unknown.
Yeah, and
at least we know now, don't we? We've got a downgrade. We can work with that. But
and also a message is being. We can clearly see a message is being passed on, and with Europe beginning to look at their deficits and their budgets. But you know, the surprise in Spain, the cutting in the rate, their investment grade down to AA+ overnight. I actually thought it'd have a bigger impact on the market.
Why was that when S&P had already done the same with Spain?
Well, Fitch is just because of the nervousness in the markets and the amount of volatility still in the markets. I thought the markets would have reacted a little bit more severely, and also because it was a very quiet day in the US, so they had a chance actually to push the US down further if they wanted to on the back of that.
123 points weaker. That's a pretty aggressive reaction.
It is pretty aggressive, but I was expecting
more. To see what 300 points.
I didn't want to see, but I was expecting more. I was expecting closer to the 200 point, which it did initially, and then it bounced back at the end of the day.
Yes.
Yep. And you know, at the end of the day, Italy, Germany and France make up 70% of the euro economy, and they are holding up pretty well at the moment.
Are you thinking that we're going to continue to range trade for the next 12 months on our market?
No, I think we probably will start to trend up again near the end of the year, but I think there's going to be another month or two of this volatility in the market. I mean, we're obviously in a fundamental buy zone, I believe, but it's not for the faint-hearted. It's more of a dollar cost averaging or getting back slowly into the market, and with a lot of brokers still haven't brought down their revisions and are still sitting at 5,200, 5,300 and reaffirming those levels. So that's a 20% rise from here, and that's very possible in this market. What
will be the key drivers to bring us back? What are you looking for? Well, what signals for renewed confidence?
We want to see the institutions start to get a bit underweight equities, and we're seeing that happen. We saw huge outflows in the US in equities over last week. I mean, the fourth largest on record since '92. And if these outflows continue and the market doesn't fall further, then it gives a lot of scope for institutions to re-weight back into the equity markets.
Do they do that in a climate of broad uncertainty, though, even on the political front? And the mere fact that heavyweights use the word sovereign risk. Yeah. It's not an open letter invitation to come into this market.
No, and it's not only sovereigns. We're seeing political risk in general build up. So we're seeing North Korea, South Korea becoming more of a problem. We had Thailand for most of this month. We've got the issues about the nuclear issues in the Middle East and who's going to sign and who won't sign the treaties that they're trying to propose. And all these issues will create surprises still for the market and shocks. But hopefully, as time goes on, the market will become more stable and can begin to rally from these levels.
Because think of a time when you didn't have those to contend with. I mean, as long as you've been in the markets, there's been a North Korea and an Israel.
And there's always been a political shock. So it's not a, there's always going to be a political shock, and there's always going to be sovereign issues. But that's not, but it's the underlying mentality of the market. If the market's in a bullish mentality, they can absorb that news.
Because what's really interesting, it's like a BP. They knew that one day, heaven forbid, something bad was going to happen. So they took out insurance. They're not going to pay for this disaster, are they? Someone else is going to pick up the can for that one. They won't. I can tell you that they're insured, and then you can bet your bottom dollar that the insurance company's got reinsurance, and so it goes on. So in that sense, do those stocks, and bring it back to the risk of unknowns with our market, what's compelling? What's cheap? What do you like?
Oh, I'm not very stock specific.
But what sectors then?
Oh, you should start to, obviously we're going to start looking back at the banks. The banks have been sold off quite a lot recently, and also the mining sector. The mining sector has been sold down heavily on the back of this resources tax, and, it's going to continue to be flat for probably until after the election, but once the election is sorted out, you're going to see a lot of value come back into the mining sector.
And you're still buying an 11% print on Chinese growth to fuel that continued growth in those stocks?
Yeah, I am, and I think that we're beginning to get a consensus that if there's going to be a landing, it's going to be a soft land. It's going to be quite a soft landing in this current tightening in China. But China's still got a lot of room up its arm to put another stimulus package in if need be, so they can maintain that growth rate.
Just clarify for viewers, when you talk about a soft landing in China, you're really meaning what? That all of the stimulus is not going to create bubbles, that we're not going to see, you know, checkered growth?
I'm talking about the recent tightening that China's been doing, and where they've been tightening on property, and it's began a little bit of a panic in China that there might be a slowdown in economic growth, a significant slowdown, and going back to what you were saying, you know, knocking it back below 8% maybe in GDP growth. And now the consensus is going, well, maybe all this tightening that's going on and these taxes that have been imposed won't really create this type of slowdown that the market's been panicking about.
Right.
That's what I mean by a soft landing.
George, appreciate it, value it as always. Have a great week.
Thank you.
Many thanks. George Lucas there from InStreet. Let's take